Hello everyone, this is Sam Hillside, your business coach again. And today's topic is all about creditworthiness and what are the points that a credit control team will need to look at before they accept or reject a request for credit sales. Stay tuned. I believe creditworthiness is too much important for both individuals and corporates. Creditworthiness is how a lender assesses that you will default on your debt obligations or how worthy you are to receive a new loan. Creditworthiness is determined by several factors, including your repayment history and credit score. Some lending institutions or banks are also considering available assets and the number of liabilities that you have when you are going to have some loans or some credit cards, and they also determine the probability of default. Your creditworthiness tells a creditor just how suitable you are for the loan or for the credit card that you have just applied for. The decision that institution or bank makes is based on some issues, based on how you dealt with your credit in the past. In order to do that, these institutions will look at several different factors: your overall credit report, your credit score, and payment history. This is for individuals who are applying for loans or credit cards. But what about corporates which are applying for trade credits or credit facilities? Trade credit is an agreement that your customers can purchase some goods or services from you and pay at a later date. It is a normal process in B2B transactions or business-to-business transactions, and it is an effective tool to encourage sales and stimulate business growth. But on the other hand, you expose yourself to some business risk that client who has just bought some products from you might not pay on time. And this can disrupt your cash flows, which is the lifeblood of your business. But how a company can check the creditworthiness of a new customer? There are many aspects to look at. First off is a review of a business credit score by running a credit report. A useful way to determine the creditworthiness of a customer is the business credit report. This report illustrates a business ability to pay invoices based on their payment history and public records. The credit report provides a profile about the business, financial data like annual sales, invoice activity, and credit limits over several years or periods. It can also provide legal judgments and collections activity, and a business credit score. The business credit score is a measure of a company's financial stability, and it can also predict how likely they are to pay you on time, those times or those periods that you agreed. Typically, the score is between 1 and 100, with a score of 75 or higher than 75 considered to be very, very good and safe. Okay, but where can you find or where can you get that report? You can purchase a business credit report. Of course, it is payable, it is chargeable. You can purchase a business credit report from a reputable credit reporting agency. The second aspect is to ask for some references. In the process of assessing creditworthiness, companies will often request trade references before they can extend credit to a customer. Trade references can include the customer's bank, as well as businesses or suppliers that already give some trade credit or credit facility to that customer. Some good questions must be asked to those references. They might include how long the supplier has been giving credit to that customer, the credit or purchasing limit the supplier is given to that customer, when the customer's last purchase was and how much was the amount, how many times the payment have been late with that specific customer. The third aspect is to check the business financial statements. Companies that want to do business with you should not hesitate to provide the financial information that will help you determine their ability to pay you for goods or services on time. To evaluate the financial health of the company, you should ask and review its certified financial statements in order to learn about the company's financial performance. You should also ask for and review the company's cash flow statement, which indicates the company's current operating results. The fourth aspect is the debt to income ratio. You must calculate the company's debt to income ratio. Another way to determine client's creditworthiness is to calculate its debt to income ratio. This calculation shows you what portion the company's debts make up its earnings. To determine the ratio, divide the company's monthly debt payments by gross monthly income. These numbers are available from the company's financial statements. As we agreed in the previous step, you will need to look at financial statements, and through those financial statements you can calculate the debt to income ratio. The lower the number or the lower the ratio, the better. However, good debt ratios vary from industry to industry, but it is important to understand what those baseline ratios are. The fifth aspect here is to investigate regional trade risk. When assessing creditworthiness of a client, it is important to review the risks inherent in the geographical region where your client is located. Country-specific credit risks are affected by fluctuations in currency exchange rates, economic or political instability, the potential of trade sanctions or embargo, and many other issues. These are factors that can negatively impact a potential client's cash flows and make trade credit risk very, very high, as that can affect the ability of that client to pay you on time. The last thing to look at is the assets to liabilities ratio. The asset to liability ratio is a key indicator of the creditworthiness of a client. The ratio compares all assets owned by a company against all debt that it owes to other companies or other individuals. The ratio is obtained by taking the value of all assets and dividing them by all liabilities that the company has. The ratio can be interpreted to provide different perspectives. A figure of 2 or greater means the creditworthiness of that company is very high. The higher the figure is, the better. If the ratio is 1, it means that the value of a company's assets and the value of its liabilities are equal. A figure that is less than 1 means that the company is overburdened by debt and it has a very high credit risk. Corporates must try to enhance their credit scores, as they may need to buy raw materials on credit, or they might apply for a loan to finance some investments in the future. I'm Sam Hussain. Thank you so much for watching me.